G'day, listeners, and welcome to another episode of the Scouting Australia podcast, powered by Australian Property Scout by advantageously. I'm your host, Sammy Gordon, and today, guys, we are very excited. I have two of the fan favourites of the Scouting Australia podcast audience in the studio with me. But what I'm super excited about today, guys, is the topic that we're going to be chatting about. And this is the first episode freshly recorded by us for you guys for the year. So we're super excited. Fresh studio. Jimmy, mate, welcome back. How are you, big fella?
G'day, Sammy. Very well. Great to be here.
Mate, great to have you here. Great to have you here. Now, talking about big, we've got the big unit, big Mr. Lukey, who is in fine form today. He's been flaring off air. Mate, welcome back to the show.
Thanks for having me. New studio, new year, new poddies. Life is good.
Not a new haircut, but I see. You did not take my advice.
Nah, same haircut.
Actually, you're looking. It's a little bit shorter. I didn't notice what you said.
If you're not listening, if you're not watching on YouTube, we've got Lukey has had a haircut yesterday.
He has. Fresh.
Sammy Gordon had his ears lowered earlier today. Fresh cut. The silver dog over here, growing it out a bit. You know, just going into
that your excuse for looking shit?
Just very lazy. Didn't get a haircut. But Lukey, it's good to see you. Welcome.
To see you too, mate. Always a pleasure.
You know, whenever we have Lukey on, I love it because his family, Sammy, his family are big fans of the podcast.
They are. Mum and Dad sit there, watch the YouTube, get the little tables out and watch it in front of the TV.
What's their review been of you so far?
I don't know. Some are hit and miss. So
the inflation versus Instagram.
They're not rating your performance.
No, the family love it. Talia is probably a bit hit and miss.
She's a bit critical.
She's like, oh, you could have moved on from that point, but nah. At the end of the day, we'll dive in.
Talia said, actually, she wrote in and said the kids love it because it puts them to sleep when you're on. So at least you're doing something well. What do you think?
That's good. That's a great point. I like it. Jimmy, the first joke of the year. How is this?
Him,
mate, that's very unlike him. Normally he gets one a year. That's probably it.
That's it.
Listeners,
my work is done.
We'll be doing an end of year recap and reviewing this.
Thank you very much. Thank you very much. Sammy, I know you want to get into a lot today.
Yeah.
So
no, it's good. It's good, boys. So this year, and what I'm wanting to start with, speaking of obviously the new year, we're a little bit into it now. But obviously speaking about, what the market's looking like and what we're, forecasting for the year and what our market outlook is for 2024. Now, if we look back at the last couple of years, especially since, in my opinion, since COVID, so we're talking early 2020, it has been quite a crazy run from the Australian property market. Not everywhere has performed the same, but for a lot of people out there investing, as a lot of people have had a lot of wins, a lot of people have started and built themselves really, really strong portfolios in that time frame as well. It's been a great time investing. But what I wanted to do was really do a market outlook specifically for 2024. Lukey, I know you've got a few points we want to run through, and it's pretty much run through everything from this side as well. But before we go deep dive into that, what I want to do is a little bit of a recap. We just had the numbers out. CoreLogic released their data, of performance over the past 12 months as well. And quite often it can be a good little recap to have a look back at past performance, where has done all right, where's maybe been mediocre, lackluster, falling behind and whatnot as well. And that can kind of sometimes fit into the picture of what we're looking at moving forward. So Jimmy, mate, I know you've got the CoreLogic stats up, man. Run us through quickly. Let's have a look at the last 12 months annually in terms of growth.
Across all of the cities. Would you like that, Sammy boy?
Yes, mate.
Yeah, so annually across the nation, we're sitting at around 8.7% annually. Up 8.7%. And obviously that's skewed across the different states. But I'm just going to wrap through all of them. So we'll start off Sydney.
You're going to rap?
Do you want me to?
Are you going to rap?
Well, not Lukey went to a rap concert, ladies and gentlemen, recently. He's going to break out into a bit of freestyling, they call it these days.
Okay, a bit of Bomb Funk MCs. Let's do it.
It's a definite side hustle of mine. Don't bring it. Nah,
does it pay well?
No.
Not for you anyway. Guys, stay tuned, because at the end, Lukey has said he is going to freestyle rap at the end of this episode. Yeah. And the look in his eyes, he's ready for it. He's ready. Hit us with the numbers.
Annually, Sydney, 11.4% up, Sammy boy.
Interesting.
Melbourne, 3.9% up.
Yes.
Do you want me to keep going?
Yeah, let's go.
Yeah. Brisbane, 14.8% up. Adelaide, 10.3% up. Perth, the star performer, 16.7%. Hobart, down. 0.4%. Darwin, down 0.1%. Canberra, 1.2%. So
up or down?
Up, sorry.
Okay.
So the combined capitals were up 10%. Combined regionals, 4.9%, which gives us the national average of 8.7 annually.
I don't know about you, Sammy, but I want to take his job off him. He didn't even order them from negative to positive.
That's terrible.
You know,
He's just reading straight off a sheet. But that's why it's Jimmy. You know? It's just, we know
he's not the stat guy.
He's a bit
He's not the
special.
stat
Yeah,
guy.
I am not an economist by any means, Lukey.
So he's had one good joke and a terrible performance on the core logic.
Yeah, I'm just reading them in chronological order.
If we dive a little into the quarterly, because I know there's been a bit of a slowing, and interestingly, we have got two capital cities there that have actually gone backwards in the past 12 months, which also is interesting, considering the amount of undersupply there is. But that's something we're going to dive into a little bit later as well. But in terms of quarterly, how are we looking with some of these cities? Like, is there anywhere that's performing really well in the past quarter, anywhere that's falling behind?
Yes. Before I get into that, the order of sequence was from the largest cities to the least. So our intellectual audience would have picked that up, but clearly you two bozos
No,
didn't.
we worry about who's winning and who's losing. But you're a loser, so that's why you look at it like that.
In terms of the quarterly, the biggest outstanding performer was Perth at 4.9% up. Closely followed by Adelaide at 3.7% up, and then Brisbane at 3.2%.
Okay.
Sammy boy.
Okay.
All of those three are definitely up.
And if you look at that as an annualized rate, if that's as a quarter, as an annualized rate, that's some pretty strong numbers. You're looking at kind of 12 to 20% sort of thing across the board.
Yes, and I suppose the big ones here, Sydney and Melbourne have definitely slowed down. I think that's the biggest
How
highlight.
are they looking in the last quarter?
Well, the last quarter, Sydney is only up 0.1%, and Melbourne is down
0.1, so
Yes.
essentially almost flat line.
almost flat line,
Okay.
and Melbourne is down 0.9%.
So almost a percent.
Almost a percent. So
Interesting to watch some of these markets losing steam, and I think one of the big things we'll dive into a little bit into this, looking at the market outlook, is probably the reasons behind that, and whether we see that continuing or picking back up. And obviously markets carry momentum, like so much about growth, whether it's up or down, is driven by momentum.
The worst performer, Sammy, was Hobart down 1.5% down for the quarter.
Interesting.
So that was interesting.
Hobart has had a very good long run as well. So it's finally kind of fizzing out on the back end. So anything else you want to run through, mate, or that's pretty much it as a wrap?
In terms of just those kind of numbers, but what I found really interesting, I don't know if we want to go through it now, but from the onset of COVID till Jan 2024, there was some stats about that. Do you want me to just run through just a couple of that? Because I found
just trying to save face.
It was incredible to see the outstanding performances of a few states, Lukey. And so obviously since the onset of COVID, what was it, 2020, 2021?
Early 2020.
To Jan 2024, as a percentage, just
So
crossing...
that's essentially a 4-year window.
Yeah.
Because it was March, April.
And this
in,
is a summary,
in 2020.
right?
Yeah.
So there's obviously outliers, which we're going to dissect. So would you like me to go from the biggest capital cities down again, following the same order?
So obviously you haven't put them in highest performing.
Let me do it from highest performing.
Highest performing,
All right.
please.
The highest performing, which one do you think?
Actually,
Lukey?
no, let's start lowest
Yes.
performing. So we're working our way up.
All
Bottom
right,
of the
the
rung
least, I'm going to quickly scan the
Let's do that.
least performer.
Yeah.
No, Mordor.
Mordor.
Melbourne, 10.9%.
In the last 4 years.
The worst performer. Closely
Is that
followed
4
by...
years?
Yeah, 10.9%, the worst performer. Followed by Sydney. Wow, 24.2%. Then we had Darwin, 24.5%. Then we had Hobart, 27.6%. Canberra, 30.4%. Perth, 49.9%. And the top two, Brisbane, 52%. And Adelaide, 53.7%. So clearly there was some big outliers. Brisbane, Adelaide, and Perth.
Interesting, though, that markets like those coming from such a low point in the cycle, they were essentially at the bottom of their cycle, and they're still, realistically, in the last few years, of pretty good growth. As an average, only really done 50 to 55% growth, in that time frame as well. I think that's a very interesting stat for different reasons. But
so nationally, it was 31.6%. But get this, if we broke it down between the combined capitals and combined regional, so the combined capitals was 27.7%, but combined regional, 46.3%.
Doesn't surprise
Which clearly
me.
shows you through COVID what happened.
The big migration out.
So there you have it.
Interesting. Very interesting, Jimmy. Thank you, mate. Thank you.
And that is my work, ladies and gentlemen, in terms of the numbers. Straight from good old Google. Lukey, any view or anything from that?
Stats great, delivery average.
Talia is going to give you a cross
To
against
be
that.
honest,
There you go.
one of the things that you mentioned earlier, where across the 12-month period leading up to now, 8.6%. At the start of last year, there was a lot of people saying property is going to not do anything, rates are going up, everyone's not going to invest, no one's going to buy property because rates are too high, no one can afford it. It really just shows, at the end of the day, I take it to undersupply. We've got a massive population growth, international migration. We've been harping on this forever, but even in the highest interest rate environment that we've had in a very long time.
And the rapid rises to get there.
Yeah, like 13 rises. Like we've had the high rates for quite a while now, and the markets are still increasing across the national average.
It's crazy.
When rates cut at some point or taper back, what's going to happen? And that's obviously what we're sort of discussing today in terms of the market outlook.
We certainly are, Lukey. We certainly are.
I was just going to say one last point here, Sammy.
Please don't.
In terms of these kind of numbers, obviously those numbers, when you think about being specific to markets,
yes.
I mean, these numbers, a lot of people would be very happy with those.
Broad,
we're talking incredibly broad in terms of capital cities. But the nuances between specific areas, if you think about the areas that APS has been buying, and I know in terms of our portfolios and what they've done, I mean, they've obviously trounced a lot of these numbers. Certain markets have doubled in value. Certain markets have done exceptionally well. So don't use this data as purely your own reference because it can skew your decision making.
Yeah, 100%.
So you really got to break
That's
it
why,
down.
man, you always got to take this stuff with a pinch of salt. And like even when you look at like median house prices of certain cities going up and whatnot, like we see some areas that have gone up, not talking specifically about that, but it looks like a city might have gone up, 10 to 15 or 15 to 20%. But then some of the locations that we bought in the last 12 months have gone up 50%, or 40 to 50%. So there can be massive disparity between those, and markets move in very different ways. That's why you have to. This is decent from a macro perspective, potentially understanding cycles and where they're at to an extent. But then obviously drilling down into a micro perspective and really honing in on that is where you're going to get your biggest wins and understanding of the markets as well.
Because it takes the entire market, the areas that grow 20% and the areas that grow 70%, and gives
Averages
you the
it
middle
out.
range.
Yeah, 100%.
So. There's definitely pockets within pockets for sure.
100%, Lukey. Now, moving on, boys, obviously talking about the market outlook for this year, for 2024. Now, I got a few things that I'm going to run through, specifically talking about. I'm kind of looking at this market being a bit of a two-speed sort of style play out that's going to happen out there. We can obviously see from a few of those markets slowing down and easing off. But then, that's going to kind of come in a different way as well, which I'm going to dive into later, kind of two types of two-speed in my mind of where I see it. I know Lukey's you got a fair few points you want to jump through, mate. But before we do that, I just want to jump through Jimmy's key points that he brought to the table for today and where his market outlook is for 2024 and the drivers behind his points.
Well, Sammy, I've given you a lot of stats already. It took me ages.
You read off
ages.
Core Logic,
Took me ages. And from a lot of the research that I've taken, my view is, given the ongoing strong population growth and the low volume of new rental stock under construction, Sammy boy, it is likely that competition for rental stock will remain significant.
What I think you should do is whoever's article you read that off, make sure you reference them so that we don't get sued for copyright.
Basically, Sammy boy, it is going to be a super boom.
That's
what you. So your 3 points.
If I was to summarize, this, Sammy boy, for you to make it really simple for you.
If you're going to read from your laptop, I'm going to close it on you.
Look at your eyes.
Okay, please.
Right. We got.
What are you still looking at?
No, I'm looking at my fingers.
All right.
We got
Hold them higher.
low rental stock.
Okay.
Undersupply of stock, and if rates cut as well, we are destined for a lot of growth. Momentum is in the market, and if you combine those three. Critical. He wanted 3, ladies and gentlemen. I've given you 3. That is what's going to make sure the market continues to perform exceptionally well in certain markets. My shoulders are getting so bloody sore. I'm carrying this episode. Are you guys going to contribute some? I thought you were the economist. What are you doing?
He's listening to you waffle to then smash you with great content.
Come on,
I'm giving you a crack. But we'll let Sammy go.
What do you think?
I've got a few bold predictions. I reckon we're going to clip them. We're going to come back to them later in the year, and I think we'll be looking at them quite favorably.
We'll get the producer to do a bit of an excerpt like later in. Plug it in. Let's see how it actually went.
Plug it in. Absolutely.
Yeah. Okay, and even though population growth may slow down, Sammy, it's still going to be elevated for this particular year. So for the next 12, we're already in, what are we in? Feb?
Feb.
Yeah. So it's going to be continually the market's going to continue to grow.
How old are you this year?
28.
Mate, you have had a rough 27 years. Lukey, mate, we're on to you. We're on to you, the big fella, the big dog, and your key points and takeaways for the market outlook for 2024, mate. Hit us with them.
Perfect. So in terms of the year, I think like I've been speaking to clients in the strategy sessions the start of this year about this very thing. Inflation actually came down through the Christmas quarter, well, December quarter. So Christmas quarter, December quarter, whatever you want to call it, came down over 1%, and it's one of our largest spending periods of the year. So we're actually down to 4.1%, which is not too far off our target range of 2 to 3%, which we've been speaking about for a long time.
Remind me where we peaked at, Lukey.
Over 7%. You know, so we've
Do you know the exact number?
I think it's like 7.6. Something
I
like
can't
that.
remember. I thought it was 8.1. I can't remember. I know I got
high
high.
sevens, low 8.
Yeah.
Do you want me to look
Something
it up because I'm the stats guy all of a sudden? Do you want me to? No, go on.
No,
Keep going.
No.
That was high. It was high.
Very
Go on.
high. So we've come down a fair way. We come down to a point where I want to make the bold call that inflation will be back in the target range by the end of the June quarter.
By the end of the June quarter.
End of the June quarter.
What are you going and like holding up grocery stores to stop people buying stuff? Is that how you're going to keep this thing in
Absolutely.
check? Really?
I feel like if it doesn't come back into a target range by the end of the financial year, by the time we add in some tax cuts and people go and get
Start
into some
spending
extra
again.
income, I don't think it'll come
You
back
know what
into
we're
the end of
talking
the
about?
year.
We are talking about. You're talking about a 6-month window.
We have 1.1% to come. We just
it's
dropped
true.
1.4% in
a
one
quarter.
quarter
Yeah.
over Christmas.
The most expensive
Yeah.
quarter.
So
yeah.
if we're dropping 1.3, 1.4% on inflation over our Christmas period, that's our most
I'll
expensive
bet you a
period.
bottle of Gatorade. Even though it's making sense, it's making a lot of sense, but I'm still going to bet you a
For
bottle
all
of
the
Gatorade.
listeners, I'm a Shivers Regal, so Sammy owes me a Shivers Regal if I'm right.
And none of
I
that
said
crap.
Gatorade, bro.
None
What
of
are you
that,
talking about?
None of that crap 10-year stuff. He wants like what 25-year.
I'm talking 30.
30
Jimmy.
plus. We're looking 30 plus.
Are you going to shout it? Are you paying for it, Jimmy?
Yeah, it's coming out of the APS fund.
Bro, I said Gatorade. The $2.40 bottle. I'll get it for $1.97 when it's on sale.
Further to what you're saying,
So-
Lukey, can I just,
Yeah.
in terms of the real life examples, so down where I'm in Melbourne, down the coast, speaking to the cafe owner there, and he was saying that this summer period just gone, because usually there's a period of time where it's crazy.
It's crazy,
People,
yeah, nuts.
you know, his business is booming and all that. He goes, mate, this year it's been the quietest that I've experienced other than COVID for a very long time, because I can't remember how quiet it has been. I was well, there you go. That's
you know what's an interesting point on that as well, right? Is that like you look at the Melbourne numbers and the Melbourne stats for how it did over the last quarter, and it's come back. Other than Hobart, it came back the highest out of ever else, right? The market's in decline. The rest of the country's moving, and it's in decline. Might be quite a decent correlation to where the house price to income ratios are. It's at an unaffordable point. We've been talking about this for ages, and as those rates kept climbing, it pushes those areas into more and more of an unaffordable area, unaffordable price point. And that's probably what we're seeing from a actual price movement side of things. Pricing is coming back, but even the fact of people out there and not spending, it's actually something I used to do when I kind of get into an area. I'll get in on the ground. You see the economic vibrancy of an area, how much something's pumping as well. If something's dead, it's a bit of a worrying sort of sign as well. So maybe you should sell up.
To be honest,
Move north. Come on, mate. Actually, no. Just move in New South Wales. Don't come this far.
Northern New South Wales probably better.
Yeah.
halfway is enough.
For us, anyway.
So, in all honesty, all we really need to see is 0.5% per quarter for the next 2 quarters, and we're back under 3%.
Yeah.
So, if we're doing 1.3% in a quarter, 0.5% is
That's
not
true, man.
not unachievable.
That's very true.
So, just because we're going to be in our target range doesn't necessarily mean we're going to cut straight away. So, I'm talking be below 3%, but our target range is 2 to 3%. So, they're probably going to kick the boot in until we're in the low 2s. Potentially,
I think they will drag it another quarter and still wait to see. I don't think it'll be a knee jerk. Oh, yep, we're in target band. Or yep, we're back at
amazing,
3.
yeah.
We'll do it. No, I reckon it will take a little bit. They definitely want it. They'll want to ease off a bit of pressure, but at the same time, they know what they probably know what's going to happen to an extent if they start chopping as well. So,
which leads into my next bold prediction.
lead us there, mate. Lead us there.
So if inflation does come under control by the end of the June quarter, I think we will have at least 1 cut, if not 2, before Christmas.
You said bold predictions, Lukey.
1 to 2 is not that much. 25 basis points on Christmas, December.
Like
That's not that bold.
Not as bold
It's
as
like-
inflation, but we could have more. But what I'm saying is,
Okay.
I very
Be
much see
bold.
the market outlook.
Go out on a limb. He went out. He called a super boom. When he at the start of the episode, he even hated the idea, and at the end of it, he had a song.
And now everyone else is copying. Everyone else is copying.
everyone's
All
jumped.
these experts.
You went early.
Stop listening to my podcast, other guys.
Even though you got nice hair. Anyway,
Lukey's changed. He went to say something and he just started pissing himself.
But I think that's bold. To be honest, I honestly think inflation will come
okay.
under.
Do you think so, Luke?
Yeah, right on, mate.
Oh,
Talia will definitely have a view on
Talia's
that.
written in. Oh, we've got the auto chatbot going. He's just saying, Lukey, stop being
She's going, thanks for stating the obvious, Lukey. Anyway,
I think inflation's bold in interest rates. I think we could be back into a normal rate for interest rates by the end of the year, if not early next year. Which, to be honest, if we get a 1% or 2% cut, you go and look at that over a course of a 500,000 loan compared to $1 million. You know, people on $1 million, what, 15 grand a year back into the pocket, Sammy?
$1 million for every $1 million worth of debt. If they were to cut, 1.5%, that's 15 grand per $1 million worth of debt. Yeah,
Yeah.
which is
Massive.
big. That's a
Yeah.
lot. That's a lot, especially if people on big loan like down your way, mate, where you got your $1-2 million primary residence, more, obviously a lot more down there as well. For every $1 million worth of debt, that is a significant cut, and that is just interest. So especially for primary residence owners on P&I and the investors that are out there on P&I as well, that probably translates into $20,000 plus per $1 million worth of debt. That is a significant amount of money, especially if there are a couple of mil wrapped up there as well. It's big.
Absolutely.
especially if we're forecasting that, and that is going to play out. For so long, when interest rates have been increasing, we've been telling people, keep in mind when this does happen, what is going to actually be the effect to your portfolio. And the people that got scared off by holding on to a negatively geared property that was maybe $5,000 or whatever, that slight change, no longer you're going to be negative potentially.
Let's say you're $5,000 a year negative on a bread and butter, 500 grand, let's say. You know, you cut a % off that, your $5,000's wiped off and you're neutral.
And the
Overnight.
important part is you've been able to achieve all of that growth of being in the market, in the right market for the last
Especially
12,
if
16.
you've multiplied the portfolio potentially and then set yourself up. You know, hopefully even buy a couple more properties before the interest rate cuts start coming in. Because when they start coming in, the market is going to change. Especially if they start coming in decent force, the market is going to change considerably.
I think there'll be a lot of uneducated investors jumping back in because good news sells. Like at the moment, like over the past year or two, it's been high interest rates, high inflation, like property's not going to do anything. All this, that's all through the news, and bad news sells at the moment. But there'll be a time where good news sells, and good news will be inflation's under control, rates are coming back. Why wouldn't you invest in property?
Market's
It's a great
booming.
time.
Yeah, of course. Yeah.
Is actually for the astute investor, the more negative news there are out there, the better the circumstances for you to actually invest. You want the majority of the market to be fearful and thinking, oh no, and then you actually want those kind of that environment.
And that's why we're probably, we're talking about the outlook and what's going to happen, but that's why you probably realistically, guys, have like a 6 to 12 month window left in this year to still take advantage of currently, I guess, lulled to an extent market sentiment out there. Because when that changes in the masses, it's going to be a different game. You want to make sure you got some exposure out there in the market before that change comes into effect. Because when that stampede comes in, we talked about momentum earlier. The way that the markets move, they'll move quick. I always talk about markets jumping. They move in jumps. They don't move. In a static 10% or whatever. They jump. Markets do jump by 30, 50, 100 grand, whatever's relevant to that price point in that market. They move in jumps. They don't move at a very steady pace. I think that's an important thing to understand.
Lukey, question for you, right? If inflation does come back, and let's just say they do eventually cut interest rates,
I'm
then
very confident. I really want my bowl of shivers.
Yeah, and everyone, well, Sammy's going to get you too. When the market, if everyone starts jumping back into the market and everything,
Tell
goes
you
on
what, if it comes in under 3%, because you said 2.5% cuts. Get us under 3. Get us to 3. It doesn't. Get us to 3.1. If we get under 3%, which is what you said originally, I'll buy you a bottle of sugars.
That was my call.
I'll buy you a bottle of
Okay.
sugars. I've actually got
You've
an
got
opened one in the cupboard. I'll give you.
I'll take that.
Nah, I'll get you a freshie. I'll get you a freshie.
Give him a freshie.
Shut up, Jimmy.
35 years.
What?
Bro, no.
Definitely not.
One of the
Definitely
real
not.
fancy boxes that he has to,
Nah.
They all
open
come in a
up.
box.
They all come. Yeah, I'll get the one in the box. I'll get the one in the box.
They're all in a box.
Sweet.
No, but this is
Wait,
the
I just give him the
fancy-
one.
the
It's the
fancy-
cheapest one. I'll put it in like a Liquorland box.
There you go. All right, you heard it
Came
here,
in a
ladies
box.
and gentlemen. You heard it here. Can't wait to replay this at the end of the year podcast.
What are we even talking about now? What's it?
What were we talking about?
You
We're talking
asked
about
me a
shivers.
question.
Oh, I was going to say, yeah. So inflation comes back. interest rates
this
drop.
thing's going everywhere.
Lukey, for someone listening out there, they're probably thinking, okay, but then if everyone starts spending and everyone jumps back into the market and things go on a tear, does that just mean inflation is going to kick back in and then they're going to increase interest rates again?
To a degree, it's going to be a very interesting period in the next 12 months.
It's a balancing act. It's going to be for the market.
Correct.
For the rates.
And very much part of that is something that we were going to mention is the tax changes coming in 1st of July. So that's where I said earlier, we really do want inflation under control before they start kicking in. They will take a bit of time to filter into the market because you're not just going to get your entire tax benefit in the first week. It's a weekly, fortnightly, or monthly benefit depending on when you get paid.
Can you run us through some of those stats? I'm curious for the people that aren't following the...
I'm going to say something even before Lukey runs us through stats, but we'll let Lukey run through the stats. I think that the important thing to note is tax cuts. Yes, they end up with a little bit more in your back pocket, but it's not like it's a ridiculous amount that, oh my God, now I have an extra $1,000 a month or $1,000 a week. I honestly don't believe you will. You will benefit from it, obviously, but it's minimal. It's not like it's some huge figure. Like if you pull out something like $800 a year, which I think I saw you say something something about $800. Like, man, we're talking not even $30 a week. Like,
and you're not pulling out $800
not even
in one
$20
time,
a week,
right? You're not pulling
it's over the course of a year.
Yeah. So it's over a course of a year. So
we're literally talking in the teens.
$80 a month.
How many Shivers Regals can you get for $800, Lukey? With the kind
you
of
buy
bottles
Shivers
that you
for about
buy?
80. I'll get the discount one. I'll buy him 10 in one here. You probably got
He's going to get his little Coles docket voucher.
Any listeners with a Liquorland voucher, Sammy needs one.
Mate, run us through your numbers quickly on tax cuts.
So in terms of what is very important to realise, and obviously a lot of our listeners will already understand this, but there was a legislated tax change or stage 3 tax cuts scheduled for 1st of July. So stage 1, a lot of people don't realise, was actually basically geared towards lower income earners. Stage 2 was supposed to be for low to middle income earners.
When you say low and low middle, are we talking low is like sub 50, 40?
It'd probably be sub the Aussie average income, right?
Yeah.
Be like sub 80.
I don't know the exact range, if I'm honest, but it was targeted towards lower income earners. Stage 2 was low to middle, and then stage 3 was penciled in for higher income earners. So when they got there, they decided not to. But at the end of the day, what is important as well, so the new proposed changes will actually 11.5% of taxpayers, or over 84% of total taxpayers in Australia, will receive a bigger tax cut than the originally proposed plan. So 84% of the population will get more money than what was originally proposed, basically. So for an $80,000 income, which is the median income in Australia, the original proposed benefit was $875
annually.
Annually, correct. It's now $1,700. So around an increase of $800.
Okay.
So
that's still pretty decent. I usually do a little bit over $30 a week, of a saving. That's still all right.
100%. I think that's great.
That's a new Shivers Regal every fortnight.
Yeah.
Maybe.
We've created a new theme for this podcast.
Alcoholic. Go on, mate. Let's rip through them.
120,000, same benefit, an extra $800 a year. So total benefit is 2,700. 160K, so 150 is really the point where it stops. You're getting more, you're actually getting less. So 160,000, you're actually going to get $950 less than originally proposed, so $3,700 a year. And somebody on 200K, their proposed benefit was $9,000. It's now $4.5. So for someone on 200, roughly $100 a week.
I think the important thing in my mind on this thing is you're talking about like the difference in it, but everyone essentially is going to be taking home more. Everyone out there, every Australian that earns an income is going to be taking home more than they were this financial year. From next financial year on, they're going to be taking home more in their pocket, which is a good thing. It's a good thing for everyone.
I think it's a great thing. Yeah.
100% of taxpayers, everyone's getting some sort of benefit to some degree. Some people are getting less than proposed, some people are getting more. But 85% or 84% of the population, so 11.6 million people, are getting more than originally planned.
Yeah, I think that's great. What's for both of you, the view on that high income tax break that was changed? What was your take on that?
So the people that are having the biggest changes are the top 15% of the population. So there's really only a very small portion of people that are having a large amount of money not taken off them, but what was originally proposed is now being repealed. So they're basically getting half the benefit.
Yeah.
They're still getting a benefit.
100%.
So $4,500 is better than nothing at the end of the day. So That top 15%, though, the whole reason the stage 3 tax cuts were brought in was to target those higher income earners and actually give them some money back, so that, generally speaking, that extra $9,000 was not going to go into cost of living. It would generally go into investing. And that's part of the reason that they repealed that, because, cost of living pressures at the moment, they're taking some of that away and giving it to people that do actually need it for cost of living relief. But that percentage of the market, that top 15%, they're generally the people that are investing into properties, that are investing into things. So the property investor side of things is really important, especially at the moment. We've got a massive undersupply of properties and rental properties. So those 15% were probably actually quite important to actually help fix part of the problem that we've got at the moment. They're not going to fix all of it, but $4,500 wasn't going to change everything.
Yeah, I don't think
but
it's
it would
gonna
have gone towards it.
Yeah, I think it was good. Personally, I think, in an affordability crisis, a lot of people are doing it pretty tough. I mean, does someone need an extra $5,000 if you're earning $200,000? I don't think it's going to make a big difference if they decide to invest or not. I think it's good.
I think it's good across the board that more Australians are going to have more money in their pocket. Like, yes, obviously, it would have been nice for the guys who are on the higher tax bracket to still be able to take that home. But if it's been filtered down through the lower income owners and it helps them, from an affordability perspective as well, then it is what it is.
Because you're still getting more money than what you were getting.
That's the thing. Every Australian who is a taxpayer is going to be better off from next financial year, and that's a good thing. And I think that's what should be focused on, not who's winning more than others. It is what it is. Sometimes some tax brackets earn more and get a better, more favourable outcome in these scenarios than others. It is what it is. Everyone is winning in this scenario, so I think that's all we need to focus on.
And the $5,000 is not going to change them from investing. They were always going to invest, so it's not going to make or break anything.
Lukey, anything else from your points in terms of where you're dictating the market heading?
So a big thing is, like, where is that money being spent? I honestly think that will slightly increase inflation to a degree. So that's where I said it's going to be a bit of a balancing act. I'm very confident in the market. I've been speaking about this with people, obviously last year and also the start of this year. When inflation comes under control and we do see some rates taper back, good news in the market is going to force people back in. They're going to get their servicing back. If you get a % or two cut off the rate, you're now going to get extra capacity to go and buy a property that you wanted to, but you couldn't potentially. So I actually think a lot more people are going to be able to buy and want to buy and jump in the market.
So because we're talking 2024, you have upped your ratio that you think 1% is now going to be actually cut off interest rates this year.
By Christmas?
By Christmas.
Is that what you're saying?
You said that. You said if 1% is cut off the interest rates, then the market's going to go crazy.
Keyword is if. Very confident.
It was your bold prediction.
Well, he said bold, but
to be honest, if we saw 2.5% cuts to the cash rate, I wouldn't be surprised. Like by Christmas, I think a % cut in the cash rate, not potentially interest rates. We don't know if banks will filter them through completely. So the Reserve Bank of Australia doesn't control what the banks do. So if they cut off cash rate back by a %, it doesn't mean the bank's going to drop you from 7 to 6 straight away overnight. So that will take a bit of time to filter through. But to be honest, I think the cash rate could drop by 1% by Christmas.
Lukey?
And if we reviewed it, I think we'd be pretty happy with the results.
Thank you for being honest. Are you going to call bigger and go bigger? Go big, go home. Maybe you get a bigger bottle of Chivas Regal if you call it.
I'm happy with my current buy.
He didn't want top shelf.
I was going to counter him and so be like, all right, well, now what's on the table for me?
He didn't want the top shelf Chivas. Look, he had a chance to get the top limited edition.
Yeah, but he knew something was going to come on the other side of it as well.
I'd never go against that.
All right, boys, moving on. Now, my points of interest, the things that I really think are going to drive the market, very, very similar to Lukey's in a lot of different ways. But I think interest rates for obviously multiple reasons. I think the market this year, until we do see some interest rate movement, is going to largely be driven by affordability out there. So if we already look at Sydney and we look at Melbourne, in my opinion, probably the two most unaffordable markets in the country. And when I say in my opinion, when we're talking income to house price ratio, they are the most unaffordable markets in the country. They were losing momentum in the back end of the year. You look at the quarter up until January 31st, they're both in Sydney 0.1, nothing, essentially flat market, and Melbourne in decline. If we look at that and we look at the momentum shift from the more expensive locations, and then we look at the momentum in the lower end markets, and yes, I mean, this is the thing. You look back 5 years ago. If someone said to you, one of us, or most investors out there that were out there 5 years ago, you get 10% double-digit growth in a 12-month window. Most people be like, that is awesome, 100%. I'll take that every day of the week. So many people these days are conditioned to, if a market's growing these days, you've got to be up by 25, 30% plus a year. Otherwise, you haven't really outperformed the average, which isn't too far off the truth. But I think what we will see this year in particular, until we see rate movement come down, and I'll jump in when I'm kind of thinking as well from that perspective, but until we see that come down, it is going to, I believe, your more affordable markets, as I've been saying for the past 2 years since we went through that shift with interest rates, they are going to be the most in-demand markets out there. They're going to have the most pressure on them, both from a local owner-occupier perspective and from an investor perspective, whether that is local or from afar. I think that is where the most pressure is going to be in the market. They're going to be, like, people are going to be able to afford to hold these things. The rents are going to come pretty close, if not some of them covering it, if not, I don't know, maybe $5,000 a year negative to hold it. It's not like buying an investment in Sydney that might be costing you 20 to 30 grand a year to hold it at current interest rates. It's a big cost. So I think, like, when you also are looking at income to house price ratios and how much movement there is potentially for growth from that perspective, I think there's an opportunity there, and I believe they are the markets that are going to see very strong growth this year. I think we're going to see a lot from that perspective. Now, where I say it's like a tale of, kind of like two cities as well, and what we're looking at from it, when we're still considering interest rates, I firmly believe we're at the peak. My honest, 100% opinion is we are at the peak. It is the question of when they are coming back down. And when they come back down, will they influence those bigger, higher price pointed markets? That is going to come down to stock levels. And it's a very hard thing to call where stock levels are going to be in 12 to 18 months, when I think we are going to see significant shift in interest rates. I do agree with Lukey that there is the potential, and more than likely, I believe we'll see at least one rate cut pre-Christmas if inflation hits the target band that Lukey's talking about as well. They're not going to pull the trigger early. They want to cause some hurt in the economy. If they're not hitting it, and they're not hitting it fast enough, and if we're almost at 3 and then we just get to 3 and then we hover around 3, I don't believe they're going to make cuts. They will make cuts when we get into the 2s and we're steadily into the 2s. They want to create, like, this is the Australian government and the RBA. They want to create some pain, which they have created. But they also want to make sure the market is kind of stalled from a lot of different economic factors. They want to see unemployment increasing, because that obviously keeps wages from growing too high. Wage growth is a heavy indicator and influencer on inflation movement as well. So I think a lot of people are calling like 1.5% interest rate cuts by early 2025. I personally don't think they're going to cut it that hard. I think we are going to see some decline, but I don't think they're going to shave it like as quickly as quickly as they raised it. I don't think we're going to see it as fast as that. I think they're going to very slowly and methodically let the foot off the brake to try and let some steam pick back up, but they're not going to cut it too quick because they don't want to risk the same thing happening and then people rush in and go, you know what, I'm going to build now. I'm going to build this. I'm going to build that. I'm going to, put all this pressure back into the market. So I think it will be slower than a lot of people out there are kind of calling it. I do think it's going to happen. Are we going to see significant growth before interest rates come back? Like, is it the biggest factor? Definitely not. All the other predicators of the super boom are still 100% in full effect. Are a huge amount of markets going to see 20% plus growth this year, regardless of what interest rates do? 100%. I'm extremely confident there are a huge amount of markets out there. Actually, I won't say a huge amount of markets. There are specific regions and specific locations that are going to see, but are there locations that are going to produce that? 100%. What's going to happen when interest rates come off? That is where the super boom, really came into effect, and it's going to go to a different level as well. So, I think it is 100% of time this year to be aggressive with your investing. I think you should be buying. I think you should be very wary of where you shouldn't buy and very clued in on where you should be buying. Obviously, that's something that we love to be able to help our clients with at Australian Property Scout, help build their portfolios, put them into the right locations, avoid locations that have seen too much growth or they're stagnating or moving into a lackluster period as well. But that's where you need to be. If you're smart and you're intelligent and you pull the trigger this year, I honestly believe you'll make a lot of money in growth in this year of property investing as well. Pretty much my two biggest points were obviously interest rates, just to kind of, obviously recap on those things as well. Tougher for more expensive areas that are in that higher price pointed, higher debt to income ratios as well. I think they're going to feel the pinch. I think some of that momentum slowing is going to continue into this year as well. and then we see how it plays out from there. Obviously, affordability is going to remain a strong driver in my opinion in terms of areas that will continue to perform. Undersupply is another huge thing. Understanding and knowing where is supremely undersupplied this year is going to provide a massive. It's understanding where might stagnate and not come back, but where is potentially oversupplied and going to see an oversupply in the next maybe 12 to 24 months. It could even be worth cashing out of and migrating your money to somewhere else. And where is really, really undersupplied that we're going to see, again, that continued higher than average growth from that perspective. And it's funny, I just kept kind of riffing and then all my points I have answered myself. So
no, well done. I think when you look at a perfect storm, it's like a multiple. There's so many different factors that culminate. You know, there's all the pressure systems are coming together. And when we were talking last time, not factoring in the interest rate cuts, you were talking about the stage is set with migration and low stock, and you know there was poised for significant growth. You add the fuel on the fire with the interest rates, like. What are the stats telling you? What is the data telling you? And you don't want to wait until it happens because you're just going to be the last. You don't want to be the last one to the party. But the opportunity is to see what's going to happen, act now, position yourself in the market to ride the growth. There's no use jumping in the back and the market's already moved. That's the opportunity cost that we talk about.
If you've got the ability to buy now and the opportunity is there for you to buy right now, if you're going to wait for interest rates to cut, guarantee you, if you had a purchase intelligently, you have missed out on a significant amount of growth. It could be 100,000, could be more, could be less if you're buying at a lower price point. But the amount of growth that you will miss out on if you sit on the sidelines of 2024 waiting for interest rates to come back. And I know I've had clients say that to me before, very, very rarely, but I used to have it said back, especially at the very start when interest rates started going up. They're like, oh, we'll wait and see where it ends up. Most of the markets we bought in since then, some of those markets seen 50, 60, 70% growth in a 2-year window. The opportunities are always there. You buy in the right market, you buy at the right price, right property, right location, you know, all these things at the right price, you're going to get the right result from it as well. So if you have the ability to buy, and I think this is the important thing as well, maybe you need to assess, and maybe you're in a very high, debt to income situation in terms of maybe your primary residence down in Melbourne or Sydney or something like that, and maybe your cost of living is through the roof because of where interest rates are right now. Maybe it is the right time for you to sit on the sidelines. But if you calculate everything and you go, no, you know what? Even with interest rates where they are, I can afford a property that is running $5,000 a year negative because I know it's going to see 50, 100, potentially more in terms of $1,000 worth of growth this year, then you can make that decision. But be calculated about it. Don't just go, nah, I can't because it's too expensive or 100%. I think it's really, really running the numbers properly, seeing what you need in your portfolio, and then being very strategic with what you go out there and you accumulate. One of the other cool things, imagine if you did a cash flow deal this year because you needed to shore up a bit of negative cash flow in the portfolio. You know what? I'm going to go out and I've got some capital here. I'm going to go out and I'm going to do 1, maybe 2 cash flow deals. By the end of the year, they're going to be finished and they're going to be rented and everything's going to be flowing and it's all going to be taking care of itself and more. And maybe they're sitting at $5,000-8,000 a year positive. But when the interest rates come into full effect, potentially by the end of 2025 or something like that, and we'd see potentially that 1.5% cut. If we're talking $1 million worth of debt, there's an extra $15,000 or more worth of passive income added back per. Well, that could be worth $1 million worth of debt, but each deal might be $7,000, $8,000, $10,000 positive. There's 20 combined plus the extra 15 on top. All of a sudden, you've got 2 deals producing $30,000 to $40,000 net passive. And I think these are the things to really look for these opportunities. What is it that you need in your portfolio? And always be looking ahead. And this is where I see opportunity. I loaded up on a couple of cash flow deals last year and the year before because I knew people were avoiding them because they're like, oh, it doesn't really make sense because of where they're sitting right now. But rents have done a massive run and they will continue to run because we're in massive undersupply if you're buying in the right areas. And then by the time those interest rates get cut back again, you've seen the rental growth. The rental growth has come through and then the rates have come back down. So you've had that double whammy of growth plus net holding costs reduced. Game time, winning.
I think that's a massive point. Yesterday, we did a cracker cash flow deal for some really lovely clients of ours. And, that was planned. It wasn't just, we didn't just rock up on the day and go, oh, cash flow deal's needed now. Let's see how we go. Let's throw it at the wall. It was planned. We look at, building out some equity and then looking to pulled a really good cash flow property in there. The yields and the cash flows on this property looked excellent, they were very happy with it. But it looked excellent at current interest rates. What if we do get a percent or two over, even if it's not this year, even if it's next year or the year after, you get a percent or two over the next 2 or 3 years, that property is going to be massive for the portfolio.
You know what the juiciest part of that is as well? Imagine you get another 20% growth this year in that location, which I am predicting we will see over 20% in that suburb in terms of growth. At the purchase price that was at, you're over $100,000 up just from growth as well on top.
They're going to be listening to this and they'll be loving that.
I'm sure they would. I think the objective, what you're saying, I think the novice investor wants high growth, high cash flow, no issues. They want the unicorn. But what you're saying is you need to be very specific as to what you need at every stage. So don't go blindly and just think you're just going to buy anything, because that's not what we're saying. It's understanding what you need, understanding what the data is telling you, and then target exactly what's going to move the needle for your portfolio right now.
And to be honest, a lot of our clients are excellent with that. They understand that you build the foundation, and these clients as well. We built the foundation. We bought some really good growth properties. You bring in a cash flow deal, and then you go and keep scaling. But that cash flow deal is so pivotal to actually going and scaling to the next level. So, it's exciting for what those clients and what other clients will do this year, because those sort of deals, are very critical to scaling the portfolio.
And man, that's where it all comes down to strategy, being strategic. Have a good look at your portfolio. You should have already done your goal setting and your planning for this year, but be strategic. What do you need in the portfolio? What's going to get you through to the end of the year and safely, and also give you a fantastic result? And that may be a couple more growth properties with where you're sitting at in your portfolio right now, but do you need to inject a couple of those cash flow deals and get that result we were talking about before as well? So that's what I love about this stuff and strategizing it and getting all over this stuff, and whether it's clients that we're working with directly, obviously within Australian Property Scout, or even students at School of Property, and they're out there designing their own stuff, whether they're working with us as well for the buying side or whatnot. I think this is super, super important to get really clear around what is it that you need next in your portfolio to keep moving forward and keep you moving forward. Keep that momentum, not get you stuck and hamstrung.
It's really surprised me with some of the calls that we've been doing recently for clients that have used a buyer's agent other than Australian Property Scout. And we always talk about strategy. But one of the first thing I asked them was, what was the strategy? And they said, what do you mean? I said, well, what was the strategy behind the purchase that you did? Oh, we didn't really talk about strategy. And I said, well, then why did you buy that? Well, that's what they said I should buy it. And I said, well, this is the most important part. It's no use looking where if you don't know what. Like, you don't know what you need.
I'll give you an example around that, unless you're going to...
No, I just for people listening, and, obviously... Australian Property Scout has done exceptional work for myself and a lot of our clients. But on the odd chance that you are using another buyer's agent for whatever chance, make sure you be very specific. Do not accept, well, what's the strategy? How is this property going to impact the next property and the next property? I want to know exactly what the roadmap is. Don't just get me the one deal, because that's not going to help you. If you don't understand the second, third, fourth and why it's fitting in and reverse engineering the end game.
But the biggest issue you've got with that, Jimmy, is most people, when they're out there trying to give that advice, or the buyer's agent, they've never been through it.
Yeah.
Name the amount of buyer's agents that have actually retired themselves on their own portfolios before they became a buyer's agent, or even created a half-decent portfolio before or during being a buyer's agent. They've never gone through it. If they can't go through it, how do they advise around it? Or how do they help you structure or help you build that thing? They can't do it because they haven't done it. They don't understand it. It's all well and good, like the book of economics and all the rest of it. You know what I mean? Like the book of trying to understand it all. Going through it is how you understand it. Going through the process, learning with it, working with, hundreds of clients with this thing as well, helping them with theirs, but also having done it yourself so you can actually give that actionable advice. That's what I actually love. And obviously I train a lot of you guys around strategy and everything. Like even Lukey's got his property economics degree. He's a smart fella. He understands a lot of things with it, but he hasn't been through it himself. And I think he's going through his own journey now, but he hasn't got himself to a retired state that most of these people most of our clients are trying to get to. And most of the listeners obviously are trying to get to as well. I think the difference and the real thing that sets us apart from everyone else, I was probably pretty much, unless there's any kids here that aren't working, I was the lowest income earner out of probably anyone that is listening to this podcast when I bought my first property.
Under 30 grand, wasn't it? 35
grand?
grand?
I was making 30, I think it was 36 grand, right? $36,000 is what I was making. It took me 3 years to get there. I was on a below average Australian income for almost the entire journey until I won Australian Property Investor of the Year. And so I built my portfolio on the average Australian income or less. And I understood how to build it from that side. And I learned and I hit everything on the way through. Like, I was talking about that pinball machine. I smashed everything on the way through trying to find out how to do this. And I learned from different professionals that I went along the way, being accountants and brokers and whatnot as well, how to play the game and how to win at this thing. And I learned from bad mistakes of engaging wrong people and getting bad advice and learning from those things as well. But we learned it from the actionable steps of how we went through and actually built this thing as well. So when I pass it on to these guys and they're looking at it and they're learning, and obviously Lukey is extremely switched on with all this stuff now. But I remember when we started, he's like, oh, is that how this works and that works and this works? And I was like, yeah. And then we learn, these guys learn how to exactly build the portfolio from that side. And I think it's a super powerful thing because not many people know how to do it. It's an absolute minority of people in Australia. It would be probably, I don't know exactly, but it's probably less than 10 people would know how to actually do this thing 100% and guide someone through that the correct way. And I think, you're saying about like people, why didn't they give them this strategy or whatever? Because they probably have no fucking idea how to do it. And if they did, they'd probably do it the wrong way. But they're in over their heads. They're like, yeah, no worries, you want a deal? Here's a deal. In a day, on market, 20 grand above asking price. No worries, bro. All good. Yeah, here's your deal. Can I have my payment, please? Yeah, there's so little goes into it from that side. And that is what separates. There's no comparison. There's no, in my opinion, I honestly I'm so bloody open about this, is that in my opinion, no one's near us on that front. From the deal sourcing side through to the level of strategy we go through from it, because no one has done it. Yeah. No one has done it. And when no one's done it, how do they compete?
Couldn't agree with you more. Yeah.
I want to give you one little example around that because this is actually how that popped into my head. Sorry, boys. I know you're both about to say something. I had a client. I actually had a touch base call with him on Wednesday. Today's Friday. Had the touch base with him on Wednesday. And another BA had bought him. These guys are on, he was on like 55 or something. And she was on like 60 grand, like nothing. And it might even be, a tad more. For some, I can't remember exactly how they were able to get the borrowing to buy something in the 800s. Like in the 800s. I think they were living at their parents' home, at the mum's home or something at the time, so they could increase their borrowing capacity. And so the guy goes, oh, well, if you got, from memory, it was like 800, I might be wrong, it was like 861,000 or something. And so that was the max they had to buy everything. So he goes out and he bought a property, or they bought the property for 861, whatever the scenario is. And it was renting for $550 a week. And he called me and he goes, he direct messaged me and he goes, mate, I'm going under. I love your potty. Listen to stuff. I have no borrowing capacity, but I'm going under. And this is a scenario. And I said, mate, send me a number. And I called him. I was chatting to this guy. He wasn't even a client at the time, but I could see this guy was like straight. I could read it through this thing. Like, I got the kid on the way. I got these things happening. I'm about to go under. And I thought he bought it himself. I go, mate, why did you buy that thing? He goes, oh, this guy bought it for me. I go, oh, right. Like, you look at their numbers. They're literally like head above water as it is then and there. And he goes, what should I do? And, well, I probably couldn't go too far into this side of things. He made the decision himself, the executive decision himself, because obviously he was snowed under. Like with this thing, his head was going under. He sold it, and he sold it even within a year of him buying it because he was about to go under. But the cash that he put into the deal, he got back out of that thing. And we just made the decision when we rolled into the next thing. We go, okay, well, we've got this back. Because he's like, mate, I'm a client for life. Like, you took your time, you explained what we had to do, how to actually build a portfolio from here. What do we do? So very, very hard to find established cash flow deals. But with the yields we were able to have in those, I was like, mate, there's two options here. We can just go super low entry price bread and butters, or we can roll this thing into a couple of different strategies here. And so what we decided to do was we went a super low entry price bread and butter, which was a couple of grand negative because interest rates are over 6%. Couldn't get this thing positive, but a nice discount on the way in, great growth location. He texted me, he bought it 6 months ago, it was up like 90 grand already, right? But then the other one was a nice established cash flow deal because he was never going to be able to get the construction loan to build this thing. It was at the time when we bought it, I think it was 450 or something like that. Very, very solid rent. It was about $6,000 or $7,000 a year positive. So he's gone from this thing that was costing him, it was over 20 grand a year. Like he was bleeding. The one deal. Yeah. It was an older property, didn't even have that great depreciation. It was in like a blue chip suburb of Brizzy from memory. And he's gone and traded that from something that was costing him that much to then something that as a net result from these two deals, and they were in significantly lower markets, he's now net like 5 grand or something in front, which isn't much. But even if he just put that into maintenance or in the kitty or in the offset account or whatever, just as a buffer for anything happening, he's in front part with that deal in that example. But he's also in markets that are at the bottom of their cycle and now growing. And when I was chatting with him the other day, he's like, oh, great news. The buffer's growing a bit. I've got all this equity release. Figured if we pull it out like this and we're working through it, I got I think he got like a 10 grand pay rise, something as well. So he was like all upbeat and getting ready to go for his next one. I go, mate, let's run the numbers and make sure we're 100% sweet. We ran the numbers, bang, we still keep it net neutral at the moment. And he's able to keep moving. That is I think in today's dollars, that is a low income earner out there, but he's still having a crack and building his thing. He's an absolute legend. You know, he's an absolute legend, and then trying to change this thing. But that is a prime example. If he'd held on to that for another year, he probably would have bloody had to declare bankruptcy or fire sale the thing and lose the money he'd put into it as well. So it was cool, man. Like, that's what, when you said that before about someone making that suggestion stuff, it just popped straight in my head. This idiot, this other bloke that's gone and bought him this thing, it's just sent these guys straight under because that was the borrowing capacity. Never structure someone's purchase around what they can buy, their maximum what they can buy. You take everything into account, you idiot. So
no, that's thanks for sharing.
Sorry guys,
that.
we went on a 10-minute rant.
That was a beautiful story. Thanks for sharing that, because I think that shows the practical reality of these kind of decisions. And if you're listening to this and you're contemplating that kind of purchase, or you're maxing out your serviceability, you're getting the wrong advice, question it, right? Question it. And I think that's exactly why you do what you do, Sammy.
What I love, and like one of the things he said to me is, he goes, mate, I wish you found your podcast earlier. Or I might have. Yeah, I think he said, I wish you found your podcast earlier when we were chatting about it, because he's like, I realized like all these things I did wrong and mistakes and things I didn't ask. I think the cool thing about the people listening to this is they're getting educated, you know, and they're looking for the idiotic things that they're being presented or shown or sent or all the rest of it. And they're becoming educated, even just listening to this. Doesn't mean you can go out there and buy A-grade properties and be a B-started or whatever, but they're getting educated around the things to look for to not make the mistakes so many people do. They may have already made them, and then it's making them realize their mistakes. And we're not doing that to obviously throw anything in anyone's face. We're doing it so that we can move as many people as we can towards, you know, the retired goal that we have as an organization. So
I think as well, like one of the things I've realized, like we did that podcast ended last year about cross securitization versus equity release. I'm even seeing less people come through, and their external broker might have said, "Oh yeah, go do this," and they're going, "Oh no, hang on, what are your thoughts on this?" And they're pushing back because they've educated themselves.
I love that.
I've had multiple examples of that, and I love that. Like that fires me up, because like that's why we do this. And I remember at the time I said we should do something because this is what I'm seeing coming through.
We
all
kept
the time.
seeing these cross securitization. We're like, man, what the hell?
Time. And then we did it, and now we're not seeing any, like, or very, very few.
That's what's awesome, you know, the way we can give back on this side of things and try and help people become more educated investors.
One thing with the strategy, right? And this is from my own personal experience, and people sometimes won't think they've achieved things until they've gotten to the end game. But the end game's 10, 15 years or whatever, right? But there is a real sense of calm once you understand the strategy and you start working towards it. Because in my 30s, when I was starting my business, I was so stressed out about money, and then I couldn't work out, how am I actually going to win this game? Like I couldn't see it, and I didn't understand it, and I wasn't educated. But as soon as we started doing some work together and you were buying me the properties and I got educated, even though I hadn't built out the portfolio, I felt a strange sense of just this calmness of understanding, the penny dropped. And the stress and the pressure of all of these financial decisions dissipated, and it was just about executing. Yeah. And that strange sense of calmness actually gives you a better quality of life, because you're like, you know what? I'm not too stressed. I know eventually I'm going to get there. Yeah. It's just going to be consistent. But all that guesswork is taken out, and that is what a strategy should do. Yeah, 100%. Is map out your journey. Because that's what life's about, is having a good quality of life. So the strategy, I mean, on my calls, I talk about strategy for probably at least 80% of it.
Yeah, right.
Because that's where the rubber hits the road.
Yeah, 100%.
So it's tough though, because like there's some places out there like where we talk about 10, 20% growth, and some of these markets doing this in a 12-month period. A lot of like long-term forecasting or planning, they won't put anything more than 5%. So like if you go and say 5% for the next 10 years, like the properties we buy more than outperform that all the time. Every time. So, you know.
But I think this is the issue with those sort of companies as well, because if someone's telling you, oh, no, it's time in the market, you just want to buy in here, and in the next 10 years, it'll go up by 7 to 10% a year, so it'll double in that time. Mate, you throw that, you know where you can throw that, and you shove that right up there, because it's just an absolute joke. You should be, if you're intelligent with this stuff, you're looking to time markets correctly. When you're timing markets correctly, you're getting the biggest wins. We're not in this game. You're not going out there and buying a property. People think investment properties for the wealthy and all the rest of it. The amount of average Australian investors that are out there doing it on average Australian income, to look at myself back in the day, you don't do it to try and big note yourself. You try and do this thing to get yourself forward. So don't do it with a 30-year game plan in mind. You're probably never going to get there, because you're going to hit too many shitty roadblocks along the way. Invest to win. Invest to win. Play the game properly. Don't invest for the long term of the time in the market and all the rest of bullshit. Play to win now.
When we play Monopoly, you're not playing to go to jail and to lose.
Mate. The opportunity
Sammy
cost.
Sammy loves
You don't
Monopoly.
want to play Monopoly. I was got a bit fired up. So let's fucking go play Monopoly.
You're not competitive, though, are you?
I refuse to play board games with family and friends.
I honestly don't think the APS staff could play Monopoly together
you-
without flipping a table.
Reframe that. Any games.
Any
not
game.
just board games.
Yeah. Your shoulder's still testament to that.
Do not play any games with Sam.
Sammy is one of the most competitive people I've ever
One
met.
of. Far out. I don't know who else there
But
is.
you play to win or you're out.
Yeah. Bloody hell. Or you might die.
But that's probably a good idea. We should.
It's a great slogan.
We should
Play
tee
to win
up
or
a-
die.
Or die. Or you will die.
We should tee up an
Anyway.
APS Monopoly day. Oh,
Nah,
that'd
you're on
be-
your own there,
No,
Lukey.
definitely not.
Um,
Definitely not.
The
I
other thing I
opt
love
out.
about
I'll
this
tell you that.
podcast, Sammy,
Yeah.
we've started with the market
I
update,
know,
but there's
we've
been
gone
there's been
everywhere.
a whole bunch of
We've gone
pearl.
everywhere.
There's been some wisdom, so much wisdom, especially in the back half. We talked data at the start. But I suppose the great thing for the second half was all about action because it's all good in understanding what the market's going to do. But if you're not going to do anything, well, it's irrelevant, right?
100%. Man, I feel like this thing took a turn when I took over with my key points. Lukey's probably put half the people asleep. Hopefully they've woken up now.
Talia is she's back on.
Talia,
she's back watching.
The producer had to call her a couple of times because she's like, "Are you still
Lukey's
there?"
finished. Lukey's finished.
Had
Talia,
to,
get back on.
Ring the alarm system to wake her up through the house. She got a migraine now, but thanks, Lukey.
Tough crowd, Lukey. Tough crowd.
Oh, guys, I think we are pretty good. What I want to do is I want to ask, what are the key takeaways? Big Jimmy, mate, what are your key takeaways from the market outlook looking into 2024? What are you excited about? What do you see coming? And give us a bit of a recap. Don't give me the super boom bullshit again.
I am super excited to get back in the market personally.
Okay.
Because for the second half of last year, I was inactive. I was on the bench with the Oranges.
Yeah.
But I am keen to make
Gatorades.
some massive inroads this year. And for me, it's all about action, right? I've stalled and done nothing for so many years, especially in my 30s, and those days are long gone. I would much prefer to have a crack and lose everything because I know I'd be able to get it again than to sit on the sidelines and let fear stop me.
Yeah, well, mate, we're talking about playing to win. That's a play to win attitude.
I'd rather you know. There's the old saying: you want to live on your feet as opposed to die on your knees. You know, so you die on your feet as opposed to live on your knees. You want to make sure you have a solid crack at
100%, mate.
And more often than not, you're either going to get it right, or B, you're going to learn very quickly, and then you're going to get it right.
Yeah.
So the only way to get it is by doing. So that's my key
Mate,
takeaway.
that's an amazing sign off. Now, as for the 3 key takeaways for the market outlook, do you want to actually give us any?
we already did those at the start. What are you talking about? The 3 key takeaways.
Key
Answer-
takeaways from the potty. From
Answer
the potty.
the question, Jimmy.
Okay,
Answer
so
the question.
Didn't learn anything on the potty?
Well, the key takeaways are all the metrics that we've spoken about in terms of the
Oh,
momentum.
fuck, I knew he was going to get there. Shut up,
What
mate.
are
Lukey,
the
you're up.
takeaways? Takeaway
The
is
key takeaways.
recapping.
Yeah, exactly. That's,
That's what I
I'm
just
saying.
said.
Jimmy,
Mate,
watch
what
it-
ahead.
Watch and learn.
All right,
Ready?
go on.
Recap of the potty. I
we go.
believe
Recap.
inflation will be under 3% by the end of the June quarter.
Uh-huh.
And I will be getting a Shivers Regal bottle from Sammy. That's a good recap.
Mm-hmm.
I believe the cash rate will decrease at some point before Christmas, but I don't think it will be to the level as ever. I'm very in agreement with Sam, where he said, I don't think it will be pulled back as quick as a lot of people think. But I do think there will be 1 or 2 decreases in the cash rate before Christmas. I think the tax changes that come in 1st of July will impact inflation in the economy. So there will be a bit of a balancing act in terms of exactly what we were talking about. We don't want to pull the cash rate back too early and give inflation the chance to run away again. Otherwise, we're going to have the same problem we've had in 2, 3, 4, 5 years' time. So I think it'll be a big year. I think there's a lot of opportunity. I think a lot of our clients are taking advantage of that. We have a lot of clients that are very keen to sort of make the most of this 12 months before they come back. But yeah, I think it'll be a big year. I think there's a lot happening in the economy. And I think at the end of the day, when we're looking at it, I think pretty much everything looking forward is very positive.
I like
Nice,
it, Lukey.
Lukey.
I like it.
That's how it's done, Jimmy.
My 3 key takeaways, in my opinion, the best things were, the biggest things to take note of, right? Some serious opportunities still out there in the marketplace. So, even though rates are at a peak, not to be looking at that as the biggest negative. If anything, I think the pre-rate cut opportunity is the best opportunity you're probably going to see, especially in the next few years. Very, very confident super boom conditions are going to continue. The rate cuts will be the jet fuel on the bushfire that we talked about that got away. That is where I think we are heading. So the best opportunities, in my opinion, are where are when those rate cuts are coming. But I do think there's still a lot of really good opportunity out there in the marketplace. Number two is market momentum will be significant. It's strong opinion on that thing. Even Jimmy with his preordained bloody past 12 months figures and past quarterly figures. I think with those figures in play and looking at those things, I think market momentum in both ways, markets that are stagnating or even starting to decrease, I think we could see that continue. High debt to income ratios with interest rates staying at a high level, more than likely for the rest of this year, even if we see a little bit of a cut. So it's going to be enough to significantly impact it. I think a lot of those markets will retain that kind of stagnant or negative sort of momentum right now. And then I think a lot of other markets that are in good flow, in good flight and momentum moving forward in an upward trajectory, I think there's a lot of markets that are going to continue very, very strong momentum from a price growth perspective. Point number three, kind of wrapping up and rounding out from something we started talking about at the back end that was really quite irrelevant to the market outlook entirely, but being very strategic with your acquisitions. I know we talk about these things all the time, all the time, all this sort of stuff, but I think that example that I rambled on for about 10 minutes about with that client of ours as well, the wrong decision, and the wrong acquisition that went into his portfolio literally could have sent this guy almost broke or make him fire sale the property. He was strategic with his decision, even though he realized he'd made a wrong one. He was strategic with his decision to sell, and then opportunistic by getting into different markets that were going to give him a better result, both from a cash flow and from a growth perspective. And the dude's up probably 150 grand now in a 12-month window. And he's in a net positive cash flow position with the two investments that he's bought, getting ready to buy another one. So it's being strategic, and that's what I hope that inspires people to look at their own portfolio and go, you know what? Has this thing seen a ridiculous amount of growth in the last 10 years? Is it what's holding me back? Do I need to sell it to then cash up and move into some other markets? Is that what needs to be done? Or do I think it's going to have more growth? So I think this is the thing. Yeah, they're my three sort of key takeaways. With the last one, obviously wrapping that up with being strategic.
I think you nailed it, Sammy boy.
Anything else, boys?
No, happy
I
with
think that was pretty perfect. Well done, guys.
Fellas, thank you for a good first step back. Very enjoyable. Love the new studio. Love the new producer. Very happy with how it all turned out. And guys, I think we're good. I think that's a wrap. Happy with that?
Happy.
Let's wrap it
Done.
up.
Listeners, I hope you enjoyed the episode. If you took great value, please send it on to anyone else that you think might also take some great value and obviously information out of this episode as well. Make sure you're sending it on, building that circle of influence of everyone around you, thinking, talking, and acting in a very like-minded way of a positive thinking with their investing. If you haven't left us a 5-star review yet, make sure you jump on, you leave us a 5-star review. Thank you very much to everyone that has done so already. We do take notice of it, and we are very, very thankful for it. And as always, guys, if you haven't followed us on the socials yet, make sure you jump on. We're pretty much on everything at Australian Property Scout. And if you want to book in a chat to speak to the big Jimmy, the silver dog, Ibrahim himself, make sure you jump on over at www.australianpropertyscout.com.au, book in the call with the big dog if you're ready to get going, up your investment game. And until next week, guys, hope you all have a great bloody year, great month. Let's get into it. Let's get investing. Get amongst it.